We've been wondering aloud, why is there so much gold bullion flowing into the COMEX, and specifically Brinks, New York, out of the 4 major Swiss gold refineries? The all-time record size stopped COMEX gold contract delivery is happening this month, June 2020. Thus far, it represents over 5.2 million ounces of gold. That's almost 161,000 of the gold kilobars you see below. Each of those gold kilobars valued at around 57 grand apiece. We've mentioned on this channel before how the coming Fiat Federal Reserve note price escalation over $2,000 an ounce is merely a question of time. All the conditions for our fiat melting gold mania phase are now coming into full concert. Headlines and common sense stories such as these highlight that this upcoming new record gold price is probably not far away at all. Article reads, World's ultra wealthy go for gold amid stimulus bonanza. More on the stimulus bonanza shortly, but let's read on. As stock markets roar back from the coronavirus-led rout, advisors to the world's wealthy are urging them to hold more gold, questioning the strength of the rally and long-term impact of global central banks' cash splurge. Before the not-gonna-say-the-word pandemic, most private banks recommended their clients hold none or just a tiny amount of gold. Now, some are channeling up to 10% of their clients' portfolio into the yellow metal as the massive central bank stimulus reduces bond yields, making non-yielding gold more attractive, and raises the risk of inflation that would devalue other assets and currencies. Well, if they ever bothered to do any full fiat currency era research, they'd know that 25% gold bullion allocation has had the best risk-reward profile over the last 5 decades of time, versus the S&P 500 and general bonds and IOUs. 9 private banks spoken to by Reuters, which collectively oversee around $6 trillion in assets for the world's ultra-rich, said they had advised clients to increase their allocation to gold. Of them, 4 provided forecasts and all saw prices for gold ending this year higher than they are now. The boost in demand could be a self-fulfilling prophecy for the metals price, as any shift in allocation from bond and equity markets, estimated up to a combined $200 trillion, has a much larger impact on the smaller gold market, estimated at less than $5 trillion. Well, if you watched our recap from last week, these figures would be making sense to you because we covered the sizes of assets around the world, and the fact that only about half of the physical gold world is bullion orientated. Nearly a quarter of all physical gold resides with government central banks, and the other quartile with prudent investors like some of you out there. And I know, $5 trillion of gold bullion layered away in hidden places around the world sounds like a lot. But hey, the 3 largest fiat currencies in the world had their respective central banks digitally create $5 trillion from thin air in the last quarter alone. How do you think gold's going to react to all this, medium and long term? Take a look at that 2008 blip. Remember what silver and gold did after that? Hello, this is James Anderson on behalf of SD Bullion. We're going to go right back to record Swiss gold imports into the United States, as hard-hitting journalist Peter Hobson from Reuters reports the following. Switzerland exported 126.6 tons of gold, worth around $7 billion to the United States in May 2020, the biggest month shipment on record, as high prices in New York continued to pull in metal, customs data showed on Thursday. Swiss shipments to China and India, usually the 2 largest buyers, remained near rock bottom. The viral crisis has turned the global gold market on its head, with purchases of jewelry and gold bars in Asia falling sharply, while investors in the West stock up on bullion as a safe asset to weather a period of turmoil. Prices on the CME Group's COMEX exchange in New York have been consistently higher than prices elsewhere, encouraging people to ship gold to the city. Switzerland, a major trading, vaulting, and refining center for precious metals, has now shipped 281 tons of gold to the United States since the start of March, 15 times more than that was shipped in the whole of 2019. Meanwhile, Switzerland shipped 503 kilograms, or 1/2 ton, of gold to India, 42 kilograms to Hong Kong, and no gold at all to China in May. Each of these destinations usually receives hundreds of tons of metal from Switzerland a year. Since the start of March, India has imported 7.6 tons, Hong Kong has taken 195 kilograms, and mainland China has received nothing. In total, Switzerland exported 141.9 tons of gold in May, and following are the numbers for May 2020 and comparisons. And you can see in that red box, 126,551 of those gold kilobars. If we add up the last two record-sized gold import months from Switzerland into the USA, we get a grand total of 7.659 million ounces of gold, which jives well with the record-sized inflows we've seen in the last few months at Brinks New York City. About 7.5 million of these Brinks New York City gold bars are in either 100-ounce or 32.15-ounce gold kilobar sizes. Remember, we've just witnessed unprecedented triple ramp in unaudited gold bullion, which is supposedly underlying the fractional reserve gold COMEX futures market. Underlying COMEX gold bullion amounts have never been over 13 million ounces since 1975 COMEX began. Open interest is down currently by nearly half of what it was at the start of 2020, and trading volumes are running at like a third of their most recent highs during the viral economic crash in March 2020. So what is all this gold for? And then we turn to King Rico desk over here. The Department of Justice is still working on prosecuting the longtime head precious metal trader and his underlings, the same pack of employees whose actions perhaps helped JP Morgan to siphon much of this gold throughout the 2010s. And look, surprise, it just shows up in the COMEX vaults. An additional roughly 9 to 10 million ounces, voila, just show up in the COMEX. Where'd JP Morgan get all that gold? If one alleged Rico trading desk owns over a third of your underlying gold reserves, is that too much concentration? What about in the overpriced COMEX silver market? I mean, we mentioned last week how bullion mints are flying 1,000-ounce silver bars from London because prices there are divergently much lower than they are here in COMEX during the burgeoning viral crisis we've just been through. Is having just one alleged Rico trading desk that owns over half of the underlying silver reserves, is that too much concentration? It's been that way for years, so I guess it's fine. Maybe Ted Butler's theory is going to be proven correct. Maybe these greed-driven alleged Rico precious metal traders at this trading desk have been preparing to double-cross other commercial banks and finally bet net long on the most important monetary precious metal price discovery market in the world. Or maybe the over 21 million documents that the Department of Justice are combing through will give away how much, at a discount, these large hoards of bullion were perhaps acquired too cheaply. Time's going to tell, and we'll be monitoring. Moving on to close this week's market update, one of our favorite billionaire silver bullion bulls was out commenting on financial markets this week. They say if you want to hear what the smart money thinks, listen to the bond market. Well, Scott Minard has been referred to as the current bond king. And here he is talking on CNBC this past week about where he sees the stock market bottoming at and why. Plus, he, of course, sneaks in how he and his clients are major monetary bullion bulls, echoing how we started this week's update. High net worth, big money is coming into bullion, and infinite QEs around the world ongoing are going to make them fellow billionaires.
Bring in Scott Minard, Global Chief Investment Officer at Guggenheim Partners, who joins us now by phone. Scott, very good afternoon to you. Thanks so much for joining us.
Oh, thanks for having me today.
Clearly a crazy roller coaster in terms of today's market moves, but all in perspective off a very strong market bounce. Do you think this pullback today was warranted?
I think so, Wilfred. I think that the run-up that we've had since March the 23rd was really built off the back of the Fed liquidity that was provided to prop up the markets. And when you consider that S&P earnings, estimates are ranging between $80 and $100 a share, a multiple of 30 times, which is roughly where we're sitting today, is exorbitant. It's the sort of multiple you would get in the internet bubble. So, clearly valuation is high. Now, as I always tell people, valuation is a poor timing tool. But the other thing we have going for us is the seasonals, and that is that the old adage of sell in May, go away has actually been proven to statistically work. And so from a seasonal standpoint, we should be expecting downward pressure on markets going into the late summer. So, I think the recent highs have been a selling opportunity. And I think we're going to have a tough slug going here, especially with the increasing number of COVID cases and that are coming up as a result of the reopening.
So a selling opportunity, Scott, is different than a bubble. Are you calling the stock market a bubble?
Well, I think if the stocks are trading at 30, maybe 35 times earnings, that yes, it's a bubble. Those sorts of valuations are really historically extreme, and in all likelihood end in tears. So I think we're seeing that. I did a call the other day on the leadership committee of the Milken Institute, and Mike Milken made a comment that this would be a good time to sell some stock and delever your company. The valuations relative to the earnings prospects are really high, and the chances of disappointment are great.
Scott, but clearly, as you've already alluded to, there was enormous government support and rates are going to stay low for a long time. How much more of a little pullback? I mean, we had 7% just today on the Dow. Does that make you then change your mind on that again? And I guess paired with that is, to what extent do you think it was retail investors that pushed us the last leg higher, and how much lower before that factor's been removed again?
Well, it's interesting, Wilfred, because institutional money, by and large, fought this rally all the way up, some of the smartest money in the world. And people, I noticed, were starting to change their positions on the institutional side and buying into the rally and saying, you can't fight this. That to me sounds like the classic throw in the towel, I've been wrong, I have to be long. And Wilfred, when you look at the charts here, the S&P, I think, is quite telling. We have broken clearly through the uptrend that was in place since March the 23rd. And so our next level of support, is, not dramatically below where we are, but it's not broad support. That support would be somewhere in the neighborhood of 2750. But I honestly think that we probably go back and retest the lows, and history shows us that it's very likely that we'll undercut the lows and get to levels that I've talked about before, which are maybe as low as 1600 on the S&P.
I mean, you may be right, Scott, and clearly, you've got the case there. My question is, haven't you been bearish this whole time? I mean, you were on with us in May on CNBC also saying, the darkest days are ahead for stocks, and
Right.
If you felt that way the whole time, you would have missed a more than 40% run-up in the market.
Well, I mean, to be honest with you, Sarah, the way that we played it was to buy high yield and corporate credit. On March the 23rd, we reversed our positions and went long. If you look at the correlation between corporate credit and high yield to stock prices, it's extremely strong. And this is where I think the dilemma is coming for the Federal Reserve. The correlation between credit spreads and stocks is extremely tight. And so this sell-off, which is now also resulting in a sell-off in the high-yield market and the corporate bond market, clearly is not what the objective of Fed policy is, which is to push those spreads in. So, the difficult question in my mind is, will the Federal Reserve try to intervene directly to prop up stocks if this continues and the corporate bond market continues just as it has today? But in terms of fighting it, I will tell you that, yes, we did buy stocks on the 23rd. We didn't buy nearly as not much, but we did go overweight dramatically in high yield and corporate credit. And to be honest with you, the biggest challenge I face today is, do I use this opportunity or strength that might come in the next day or two, because markets very seldom go straight down, as an opportunity to reduce our exposure, and that is probably what I'll be thinking about for the next 24 to 48 hours.
But Scott, you said S&P could go to 1,600, so it could almost half from here. I mean, and if that's a possibility, I'm surprised that you don't already have zero weighting to equities and have 100% weighting to gold.
Well, you know, one thing that, Wilfred, is that it's important in portfolio theory to maintain diversification. That is that the correlations between assets are not one. That is that if some assets go up, others go down. You know, I'm not omniscient. You know, I just can basically look at valuation and say, and the economic environment, and make judgments as to what I think the right prices for securities are. So, you know, you could say I should be 100% out of equities, and you know, look, it's a fair comment. But in the way we manage our clients' accounts, you know, what we try to do is minimize the risk of drawdown, which means you have to have negatively correlated assets along with your other investments. And we do have a substantial position in silver and gold. So you are right, and we have a lot more silver and gold than we have in equities, and it's been a trade that's worked at least to date.
Scott, thanks for joining us.
Thank you.
If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about. We're going to make them fellow billionaires.